Let's get one thing straight from the outset here. You probably can't pick stocks. Despite this being statistically very likely, there is no shortage of investment bankers who will tell you some tip over a beer, or a family friend who bought this or that stock before it doubled in value or 10x'd. The problem with all these stories is that the storyteller only tells you of their wins, not their losses. This is a classic survivorship bias. Survivorship bias is a type of sample selection bias that occurs when an individual mistakes a visible successful subgroup as the entire group. So if your mate John tells you about two great stocks he bought years ago that have performed well above average, you'd think his portfolio is doing well, and you would think he's quite the investor. But what if John isn't telling you about the other 8 stocks he bought which haven't been performing as well?
That's a little misleading.
In other words, survivorship bias in investing occurs when an individual like John only considers a surviving observation without considering those data points that didn't survive in the event. That is to say, the losing shares. There are obvious reasons why we don't talk about our failings. We're humans. We all, to varying degrees, have a natural tendency to seek the approval of others. It is how we're wired. We would rather people think we're good investors and we're good with our money, rather than, for example, thinking we're idiots who lose money. Look, investing can bring you many benefits, such as helping give you more financial independence. As savings held in cash will tend to lose value because inflation reduces its buying power over time, investing is a great way to help protect the value of your money as the cost of living rises and also give you a growing asset. It's a very good thing to do for your own financial well-being. The question isn't whether or not you should invest, but how you should invest. Successful investing is all about common sense. The answer here is really quite simple, but it's not easy. It is smart, but it's not sexy. Simple math shows clearly to play the game of averages. Don't own shares in the market, just own the whole market. This should represent the majority, if not the entirety of your portfolio. For 99.9% of us, it does not make sense to pick individual stocks beyond a small part of your portfolio, which allows for more speculative investments. By owning the market at large through broad index funds, you benefit from the entirety of the market movements. Now, you do limit yourself from the fanciful 10xing, which is possible, but very, very unlikely.
That is not going to happen.
You won't get rich quickly with broad index funds. But importantly, as you trade away your chances for 10xing, you also limit your downside and you're not exposed to the loss of your capital unless the entire market ceases to exist, which is A, unlikely, and B, if that happens, we're all ruined anyway.
Too optimistic!
This investment strategy is what John C. Bogle and Vanguard pioneered decades ago, which now so many companies model because it is statistically the smartest thing to do for literally almost everyone. I'm not saying you shouldn't pick any stocks.
Buy low, sell high, that's my motto. I may just quit my job at the power plant and become a full-time stock market guy.
But I will confidently say that you probably can't pick them well enough to have your entire net worth tied up in the accuracy of your selections. Let's be honest with ourselves, guys. We're not good at this. I myself do not pick stocks individually for pretty much the entirety of my portfolio. And as a banking and finance lawyer, I'm actually better placed than the average person to analyse financial statements of companies and market movements more broadly. And even I know I'm not going to risk my net worth and future on my ability to do so. I have the overwhelming majority of my portfolio in broad index funds, capturing multiple markets around the world, as well as a listed investment company and real estate investment trusts. It's not a sexy portfolio, but it works. In addition to this, I own properties and I have a growing 401k equivalent, which also gives us exposure to the market more broadly. Only a very small part of my investments are in specific companies, less than 10%. This strategy is statistically likely to end well for me and my wife, and has done well for us over the last 6 years since we graduated law school. Yes, it isn't sexy. And on YouTube, where a bunch of financial influencers love to flex all about the sorts of quick riches and brilliant stock picks, I can see how this strategy doesn't resonate with our human desire to maximize our returns and riches. But the reality is that by taking the risk of picking stocks for potentially higher returns, you're also exposing yourself to the potential or complete loss. This downside has such a negative effect on the compounding of your investment that you simply should not expose yourself to it with the majority of your portfolio. Rather than listen to the siren songs from investment managers, investors, large and small, should instead read Jack Bogle's book, The Little Book of Common Sense Investing. That is the quote Warren Buffett gave for that book. It was the inspiration for this video, and it is a must read for any investor. Since graduating law school, I've worked extra jobs, and because of this, I was able to invest and my portfolio grew pretty quickly for a new law graduate, through no brilliance of my own. This was simply me working hard and taking the safe bet. But it looked good, and people would ask me, how do you invest? Well, this is the book I've bought for people when they've asked me for advice. This is the book I recommend to people when it comes to investing, rather than to tell them what stocks to pick, because I am not an investment analyst, and I wouldn't even trust what an investment analyst would tell me due to how inaccurate their predictions tend to be.
Ninth best performer year to date is SVB Financial, don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. I think the fears were not justified, and it's a very compelling situation.
This is so embarrassing.
Even the best of us are rarely good at these predictions. It is a very, very difficult thing to do and involves so many variables that the chances of an accurate prediction are simply not good. Unless you're the next Warren Buffett or Howard Marks, which is 0.000000001% of the population, you should be focusing on doing what you're actually good at to earn a high income and then investing that wisely. This is, statistically speaking, the smart thing to do. Thank you for watching, guys.